Hey, Vince, thanks for joining the podcast today. I appreciate you making the time.
Hey, Jeff, it's great to be here. Thank you.
You're kind of breaking ground as our first fellow fintech to join the podcast, but I'm really excited to have your perspective here. You've been in the lending industry for a long time, so I think it'll be a lot of interesting insights for our listeners.
I feel very privileged to be the first.
Now, do you want to give us a little bit of your history and specifically tell me a little bit about what Lendkey does, since not everyone may be as familiar?
Sure. So, look, we founded Lendkey back in 2009, and really we founded the business to really be a lending as a service platform. And what we do is simple. We just help our clients digitally originate and sell and purchase loans. And we use a couple of core capabilities in order to do that, which I think you'll find very familiar. The first is we help them with digital lead generation. And as I always say, credit unions are probably the best kept secret in the financial services industry. So we needed to make sure that consumers knew they were there. So we did lead gen for them. We're a multi-asset digital origination platform. So we do education loans, we do education refinance loans, and then we do unsecured home improvement loans. Now, having started in the education space, we needed to be a turnkey solution. So aside from origination, we also do loan servicing, and we have a call center where we handle the origination calls and the servicing calls for the clients. And then we are a balance sheet light solution, so very similar to Upstart. We originate directly on the balance sheets of our clients. Now, given the assets we deal with, especially education, it's important that from a regulatory perspective, they're originated in a certain way. There's a certain process and a very specific regulatory framework, and they have to be serviced a certain way. So we have built a very, very stringent compliance framework. And we have been through thousands of audits at this point, because we have over 325 clients on the platform that we've originated about $4 billion of loans for. Now, I think what makes us unique is that we really developed this expertise from day one of creating what I call network lending programs, where we realized from the very beginning, credit unions are very cooperative, and they participate in loans all the time. And they do it for a couple of reasons. They do it for capital preservation when they need to preserve capital, but they also turn around and participate in loans for geographic diversification. And so from day one, we allowed our clients to real time participate loans out when they're being originated. And we have built out some really robust networks, one for education refinance, and one for home improvement. And then recently we opened that network up so that our clients, when we saw the pandemic hit and the recession that hit as a result of it, we realized that, hey, there are going to be a bunch of assets on the balance sheets of credit unions that need to be deployed. They're going to be looking for all kinds of loans. Let's help other fintechs. So we launched a product called Lero earlier this year, which allows other originators to drive traffic to us, and then we move it through our network in these what we call private forward flow networks. So that's who we are, what we are. So about 325 clients, been around for about 10 years, almost 11 years now, servicing credit unions and community banks.
It's always hard to believe when you cross that decade mark, isn't it? We're about 6 months shy, but I think has it been that long? So tell me a little bit about student loans. Like, why the education market? I mean, that was kind of where you started off, right? Was in the student and the educational loan refinancing. What was it about that segment that made you think, hey, this is a space that needs a better solution, or there's room for a new player?
Well, look, you remember 2009, wasn't that long ago. So we started the business in the shadow of the Great Recession, very similar to yourselves. And what we realized was that there was really a need for someone to step in and to recapitalize the balance sheet for student loans, because post the Great Recession, a whole bunch of lenders exited that business. People like Sallie Mae cut their originations in half because they were highly reliant upon the securitization markets at the time. So we saw the need and said, well, who better to serve that need than credit unions? And also at that time, you would think back 2009, the average age of a credit union member was probably about 55 years old. So credit unions needed to get young. Student loans were a great way for them to help their member finance their education, and also to acquire a younger member, or to really sort of go multi-generational, because they had the parents. Now they needed to get the family. So, and it really worked out well. There weren't many credit unions in the private student loan business back in 2009. Today, there's over 1,000 credit unions that are originating education loans. And as you know, right, because your business like mine, we're out there trying to help consumers find the best price on these loans, and credit unions have the lowest cost of funds. So It served the consumer, it helped credit unions service their members, and helped credit unions really put great assets, great performing assets on their books.
Yeah. And let me ask, you talked about digital lead acquisition, and I often think of financial institutions and credit unions in particular kind of focusing on their current member base when it comes to lending products. What was it that kind of drove you? You see that you acquire the deposit, you cross-sell the loan, whatever, but you're really talking about, doing digital lead generation for them for these net new clients or mostly to their current client base. I'm curious how you got into the kind of digital lead generation and why your clients find that to be so important as a part of the solution versus just kind of doing a standard, I market out to my current member base approach.
Yeah, so I think the first is it made all the sense in the world for credit unions to really gravitate towards this is a way for me to get a new client. Because as I said, if you think about the age of an average credit union member, they needed to get young, and getting exposure into the schools, getting exposure into affiliate channels where we could drive education refinance loans made sense to them. So the majority of the traffic is traffic that we drive for them in the education space. In the home improvement space, it's a product that's sold, not bought. So in the home improvement space, we're dealing with contractors. So the probability that contractor is dealing with a member is probably pretty low.
Yep.
But it is the best way to acquire those loans. And in our case, we have contractors selling pools and spas. It's mostly the luxury market right now, where that contractor is able to then turn around and represent a credit union's loan to their client in closing it. So they need to get young, and in some cases, the product is being sold by, call it a merchant, right?
Yeah, I'm curious about they're unsecured loans, right? Your home improvement loans are not like HELOCs. I get called all the time from various groups, either HELOC executives at a bank or committees representing different institutions, and they're seeing the kind of home equity lines of credit or home equity installment loans dropping generally in balances. Do you see a trend towards this kind of unsecured for home improvement purposes? I'm kind of curious about that product because, HELOC has been one of the kind of non-mortgage consumer loans of choice in terms of at least banks and to some extent credit unions historically. And this seems like a different thing that's filling a similar need. So I'm kind of curious what you're seeing in that space and how you see those kind of competing, sitting side by side, et cetera.
Yeah, so I think there's a very specific time and place for an unsecured home improvement loan, and it's mostly being driven by the demands of the contractors that are out there doing this. So in the luxury market, it's pretty similar. It's about speed. You have a contractor who's at the point of sale. They are now sitting with a client. They might be pitching them on replacement windows. They might be pitching them on a new roof. And as a result of doing that, and especially when you think about HVAC, right? In many times, they really want to know that they can get this customer approved and then they can move forward in the sales process. And it is no different than what we see when you show up in an auto dealer, like you did today, right? And you purchased a vehicle. It's all real time, and this is what we did in my previous life at Dealertrack is really that instant decision and the ability for that merchant to move forward in a transaction. So I think it's being driven by the demands of contractors who are out there and merchants who want to turn around and know that they're at the point of sale, they can get quoted on a rate. And as a result of doing that, just like any even buy now, pay later, it affects the purchase price.
Well, it affects the conversion rate, like it affects the purchase price, but ultimately I think a lot of buy now, pay later is also about how do I get the buyer who's here in the moment through the funnel converted and actually able to purchase and not, whenever you say, hey, come back in the case of HELOCs, I hear a lot of banks, it's still a 25, 30, 45 day process. Right. That's not a great answer for a contract. Come back in 45 days and I'll tell you if I've got my loan. That's not a great answer.
You're right, Jeff. And also, if you think about it in the repair market, and we'll all come on it right now, we're going to go into heating season, right? No heat calls. The consumer turns on the heating system. It doesn't turn on. They make a no heat call to their contractor who shows up, tells them we have to replace your heating system. They can get it done probably in 24 hours. That's not enough time for you to go get a HELOC, and you didn't expect this to happen. So you're either going to put it on your credit card, or you can get an unsecured home improvement loan, and you can get it in real time.
Interesting. Do you think about the real-time aspect outside of decisioning in terms of how quickly you can get someone not just from here I am, what do I qualify for, but all the way through to getting the dollars in the loan, in the funded in the borrower's account? I mean,
All the time. In education, you have a little bit of a runway because typically the start of in-school lending season is probably right after July 4th. But the majority of our loans are booked in the last 3 weeks of August. And those funds have to be in the school by the time that student shows up and is moving into their dorm. So we've got a real deadline that's associated with it. The refi side, it's really up to the borrower, right? The borrower is paying off another servicer, so it's really up to the borrower how quickly they want to move through the process. On the home improvement side, it is about speed. The contractor is starting a job. If it's a construction project and they're going to dig a hole for a pool, they want a third of the payment before they dig the hole. If it's a repair project, in many cases, they're going to want to get paid as soon as they're done. And in some cases, like a no heat call, they may get done in 24 hours or less.
Yeah. Interesting. Do you see, do you look at on the refi side where there's not kind of an external deadline the way you have in the in-school or the home improvement where you got a guy with a big excavator sitting out in your front yard going, I need a third down before I can go back there and dig the hole for your pool? Or, for us, I had my AC on my roof blew out like 5 times one summer. I blew fuses because it was 105 degrees, and I was running to Home Depot buying new fuses going, I think I need an upgrade. How fast can you come here and get me an AC that's not going to blow up every time it clears 100? I didn't want to wait. But on that refi product, you do have more of a borrower-led. But do you find any drop off from borrowers as the process is slower? Any improvement to your business as you're able to simplify or shorten the time frame that it takes a typical borrower to get through that experience?
Absolutely. And we spend a lot of time looking at ways to take friction out of the process. You originate personal unsecured loans, so you know what it's like, right? Your experience is you apply and you pretty much are done with the process. You can move pretty quickly. There's a few friction points, and over the years we've eliminated them over time. But I always tell people it's about the 3 Ps. It's about the product, it's about the price, and it's about the process. And what do they want to know about the process? Make it as fast as possible. Show me you know me, and get me through the process as fast as possible. And one of our big clients, that's their mantra is show me you know me. What does that mean? It means, hey, you don't need to ask me my name, my address, you don't need me to fill this out. You can pre-fill it. You know my income because I'm a member of your credit union. Just get me through this as fast as possible. So it absolutely affects conversion. And as you know, that conversion rate really helps when you're out there competing for leads in the market.
Yeah, when you're doing digital lead acquisition, the conversion rate, 25% increase in conversion rate's a dramatic drop in your cost to acquire. So as you're out there in a competitive marketplace, that's the difference between profitable and the thing that happens when you're not profitable for too long, which is usually non-continuance of business if you keep losing money. So absolutely. I love that, by the way. Show me you know me.
It's not. I can't take credit for it. It's one of my clients. It's
not mine. I won't take credit for it, but I got to highlight one that I think makes sense because it's an interesting mantra and it sounds so simple, but I think so many institutions execute so badly on that. And not to pick on any guy. I won't tell you who my bank is, but I went through a mortgage refi process with the bank who's got my 401k and my checking, and I go to a form, please enter your name, please enter your address. I'm like, I told you I wanted to refinance my mortgage. You send me my statement every month to the address. Like you know what it is, but they were like they'd never met me before when I went into the process. And I think it really has an impact these days more than ever. Consumers expect more. All right, they get more from Amazon, they get more from Uber, and they expect more from their financial institution that maybe has the most sensitive pieces of information and their most valuable assets.
Absolutely, I agree. And I'm sure, look, you're doing that with your product as well. It is about conversion rate. It is the reason why our clients come to us. They're trying to build relationships with both existing clients, expand relationship with existing clients, and they're trying to build relationships with new clients. And I've listened to a couple of prior podcasts when we talk about fintech relationships and why they're being built. And a lot of what's driving it is the ability to digitize these experiences and to improve turn time and conversion rates, but also, to that point, to really make it a customized experience. So the consumer says, wow, you do know who I am, right? How many times we see, I remember my early days at Citigroup when I used to tour the branches when I was the CTO, and every once in a while you'd see an exchange on the teller line, right? And what was it? It was somebody on the line who was upset, and they said, do you know who I am? And then when they finish, it's like, I have a mortgage with you, I have this with you. And the answer
Yeah,
is
yeah,
no, they don't. That's the reason why you're on the line and you're last on the line and you weren't put on special service line.
yeah, yeah, yeah. Interesting. I'm curious. You mentioned your kind of history at DealerTrack, and you talked about you guys are in education, refinancing, and in school, and you're in with your partners in the kind of unsecured home improvement loans. What do you see coming in the auto space? I mean, we're obviously have gotten into the refi space at Upstart with our partners. I think that's a fascinating space, but I'm also seeing the kind of emerging e-commerce, the kind of traditional indirect being not a very, I think a lot of lenders don't love that because they don't feel like they get a very strong member relationship through an indirect auto loan, even if they can put a lot of assets on the book. So it feels like an area ripe for disruption. I'm curious if you have any thoughts on what you see coming in the auto finance space, because it feels like a lot is afoot there.
Look, for years and years and years, I should say for decades, right? No one would touch the indirect model. It was just, credit unions have relationships with dealers. It makes all the sense in the world. I think a couple of things have happened, and obviously the pandemic generated a great deal of it and pushed us over the edge, which was, how do you go from indirect to direct, and how do you get the consumer to do it, and more importantly, how do you get the dealer to be comfortable doing it? And Carvana is a very good example where you have a founder who started a buy here, pay here type business in the subprime space, who said, let me figure out if I can disintermediate myself, and created Carvana. And I think it's a very, very interesting model in what they've created, right? The entire experience is online and the car is delivered to your home. Tesla, where they said, look, we're not even going to have dealerships, right? You'll go take a look at the car if you want to look at it.
Showroom, not a dealership, right? We don't have inventory. We just have a couple models. Go check it out. Sit in it.
So look, I think the pandemic has done a great deal to digitize things because we just had to. And as a result, consumers out of necessity, even baby boomers, right, have moved to the digital channel because they had to. And we've had a couple of shots at this, right? We had 2000, whenever it was a great .com, push, right? Then we had 2009, the last Great Recession. But this one really pushed us over the edge because there was the inability to get to the physical channel. Plus, look at the kind of capacity that we had to do it with, right? Because back in 2000, we couldn't create the kind of customer experiences for lack of bandwidth. So I'd say that technology was there, desire was there, unfortunately, because of the pandemic. And I think as a result, we took a process that really wasn't great, right? We all watched that Carvana commercial, right? About I've gone to some of those sales schools with dealers and what they actually do. I got to talk to my manager. We used to call it the box. We put you in the box and then we try to sell you. So it's a much better experience. And I think what we're seeing more of is that dealers are coming full circle and recognizing that the dealerships are going to become more like showrooms. You'll set an appointment to show up at the dealership to drive the vehicle. But most of what you're going to do from home. You're going to configure your vehicle. You'll turn around and you'll research your vehicle, and then you'll complete the transaction if you want to go into the dealership. So I think that's a very big change. I mean, you talked about refi, and I think refi is really important. It's a product very similar to when we entered into the education refi space, where very few consumers know it's available, and especially now, price of vehicles continue to go up. Right? Think about it now. The average length of an auto loan is about 6.5 years. Yeah. The average balance of an auto loan is about $35,000. So it makes all the sense in the world, especially in this inflationary times we're in, for a consumer to turn around. They're paying on average over $450 a month for this auto. If they refinance this product and they add 2 more years on the back of it, they can drop that payment down to $325 and save that money to maybe invest it in a warranty. So if there is an issue, because they're going to hold the car longer, it's covered under their service plan. So there's lots of reasons for that to happen. So I think that's another big piece. You're going to see consumers pay more attention to that payment because they're going to have to deal with it longer because they're going to hold their vehicles longer. Yeah.
And the other thing, I thought your point was really interesting about the availability of the technology. We see something similar in the refi space, which is kind of the number of, the cost to execute the refi kind of indicates how many people you can refinance and save money because you got to recoup your cost. And as technology has, allowed us things like electronic lien and title transfers, have and been able to reduce the cost of actually making the refi loan available. You can pass that on in terms of more consumers that you can save enough money to make sense switching. And so I think that the technology is coming where, hey, we can automate a lot of the verification. We can do instant rate checks that are automated through. We can pull that manual cost out of the system, and now the number of people we can actually put into a refi and save enough money to buy a warranty package or be meaningful in their budget actually increases quite a bit. And so it's kind of a moment where the product kind of its opportunity is expanding because of the prevalence of technology to make it more available and more cost effective for lenders than it was 10 years ago. Or God, it's hard to think that 2000 was 21 years ago, but 21 years ago.
Exactly.
I'm not going to do that math again. I don't appreciate you making me do that math today, Vince. Let me ask you, so you've been at it for a decade with Lendkey. What are the biggest things you've learned, and maybe the biggest thing that surprised you in that journey? I'm sure there's been a lot of twists and turns along the way.
Yeah. So look, I think people sometimes look at us and say, how'd you acquire that many customers? And I tell people, look, you have to be patient. You really have to be patient. Our clients are very discerning. I worked at Citigroup. I was on the other side, right? I was a CTO, so I was a purchaser of technology, and I thought we were difficult. But I've got credit unions, $100 million asset credit unions. I've got a $10 million asset credit union on the platform. They're very discerning. They have to be, right? They're highly regulated. The NCUA really requires them to conduct diligence, very deep diligence, especially when someone's servicing for them. So I learned to be very patient. I always joke around and say, I started this business, I had black hair. Now I have this full head of gray hair. So you do need to be very patient. And I joke with my clients about it because I say, yeah, I'm still around and I'm very patient. So that was the first thing. The second thing was, you really do need to engage the regulator from day one. And think about it. I called the regulator in 2009. I called the head of enforcement at the NCUA, and I introduced myself and I said, I am going to put credit unions into the education finance business in a loan participation model. And their reaction was, after he listened for about 5 or 10 minutes, he said, Vince, you have a target on your back and we're going to put you out of business.
Not a good first call with the regulator.
Yeah, and honestly, I spoke to him not too long ago, and we joke about it now, but we continued to engage the regulator every step of the way. We made ourselves known to the regulator both on the credit union side and on the community bank side. And regulators are never going to endorse your product, but providing the opportunity for them to know who you are as a business owner, to make them very clear about what your product does, to make yourself available to the examiners when they're in the field reviewing your product, really critical. And I think you know that because you guys are following some of those same paths. So I think it is important to really engage the regulatory environment when you're going to do what we're trying to do. You can't disrupt that environment.
No, that's really good advice. I'm curious if you've seen any shift in, I won't say that the level of discernment of your clients, but I feel like more credit unions and community banks are becoming comfortable with the idea of partnering with fintechs, and their muscle around diligence, review, oversight is something they're strengthening, they're getting better at. And I think the regulators are getting more used to and understand how they react to. And I'm curious if you're seeing that in your business where, there's a little more clarity, a little more comfort with the ability to engage in these kind of relationships, the way to oversee, and what's going to be expected by the regulators when they walk in the door.
Yeah, so the answer is yes, but we also need to be honest with ourselves what's driving some of it. We all understand there's a liquidity crisis. The number of deposits that have flown into these organizations is unprecedented. The loan-to-share ratios of credit unions now is probably the lowest I've ever seen it since I started working in credit unions. So there's probably some, $700 billion of assets deposits that need to be somehow invested. And the regulator is very much aware of that because that's not a good thing for the credit union system or the banking system in general. Yep. So there is a forcing factor right now that says it's impossible for them to turn around and do this on their own. And the reason why I say that is not to put a damper on the enthusiasm. It's because when that turns around, and it will,
yep,
they're going to be just as discerning as they always were. Because remember, there's an insurance fund behind every one of these agencies, and that's what they're there to protect, right? We don't want to turn around, you and I, and help our clients acquire loans that don't perform. And in
Yeah.
their enthusiasm to go out and get these portfolios, we need to make certain, because like you, right, we assist them in underwriting and pricing, that they really are acquiring portfolios that are going to perform over the long haul. Because
Yeah.
that still exists today. And all that diligence is about making sure, right, that they're originating these loans properly, these loans are going to perform, and they're going to be serviced properly.
Yeah, I think it's very true. It's a good point. I don't know that I would say the level of oversight or diligence is reducing so much as people kind of understand better how to do it, where to do it,
Yep.
and they're comfortable that if they do it well, it's a place they can go to. But you are right. The liquidity crisis is interesting. It took me a while to understand. As somebody from the tech space, I went, well, extra cash in the balance sheet is good, right? Like when your business generates more cash, that's like always a good thing. And of course, it turns out in the credit union, the banking space, like excess cash is not a good thing. You've got to, I mean, those are assets that aren't being put to work. And so it is a challenge that I think is driving a lot of relatively short-term activity because people need to solve that in pretty rapid order.
Yeah. Now, on the positive side of the equation, having met with the regulators, and we've seen it across the board, both the OCC, the FDIC, and the NCUA are building in their organizations individuals that are in charge of fintech partnerships,
Yep.
where they are going to do outreach. They are going to try to help fintechs understand how to partner and what's required of them to partner. Where in the past, it was more a defensive posture. They are shifting now to more of an offensive posture to say, okay, I am now going to explain to you, fintech, how you engage with me. In 2009, when I started calling on credit unions, I had to go searching for the letter that the NCUA created, which was memo to credit unions on what you have to do to diligence a servicer. And then I built my diligence packages based on that.
Yeah.
Today, I would say we're probably months away from these regulatory agencies issuing this stuff directly to fintech saying, this is what you're going to need to do if you want to engage with some of my members.
Yeah, we've already seen some of the regulators providing increased guidance, increased examiner manuals on third-party relationship diligence, and we can kind of reverse engineer what that means. We need to be providing as a partner for them to go through that. But it'd be great if they just came directly to the fintechs and said, here's what we expect from you in terms of those partnerships. So I hope you're right on that. Months, you said. Maybe that can be your bold prediction for us, Vince. Is there anything you wanted to talk about that I didn't bring up so far in this conversation? Anything you thought we ought to cover that we haven't gone over?
Well, look, I think in the spirit of some of the things you discussed in some of your other podcasts, I would say that partnerships are really important. Building good, strong relationships with credit unions is super important. My experience with credit unions they are probably the loyalest customers you'll ever get. But in order to do that, you have to be fairly transparent. And we have a big responsibility to do that. That means that they have to understand exactly what we're doing because we're helping acquire customers for them. We're actually servicing their clients for them. So it's an important part when we think about partnerships. And we go back to lessons learned. Transparency is probably one of the key things that we push very hard in the organization. I typically sit like any big operation. Every once in a great while, you make a mistake, and I'll sit with my staff and go, well, the first thing you do is call the client and tell them you made a mistake and explain what happened, apologize, and then explain how we're going to fix it. And I think that goes a long way because having sat on the other side of this, if I outsourced a function to a vendor, I'd want that transparency.
Yep.
So I think the key to success, and I'm sure you're seeing it too at Upstart, is being that transparent to your clients when we're doing what we do every day.
Yeah, I think the key to success in the long term is trust of your clients, and that trust comes from transparency, honesty, dealing with difficult. I mean, mistakes get made. It does happen, right? You don't love it, but we know what happens inside the institutions, and we know it's going to happen on occasion when we're working with them. So I do agree that you got transparency, patience, and regulatory engagement. It's a very good piece of advice for any fintech that wants to get into the partnering with FIs more broadly. So I think great advice there from you, Vince. And then I end most of these discussions with the same three questions. So I'm gonna throw them at you now and see what you got. But the first is, what's the best piece of career advice you've gotten?
I'd say pay it forward. I remember when I was promoted by my manager to become a manager, And I was very grateful for him mentoring me and helping me along the journey to actually become a people manager, which was a huge milestone, right, in anybody's career, and a privilege. And he looked at me and he said, I want you to remember how you feel right now. And I want you to turn around in your life and your career and make others feel that way. And in your future, you'll always build, you'll be a people builder, right? And that's how you build successful businesses. So I try to always think of that. And when I'm coaching my new managers, I always tell them the same thing. When they say thank you, I always stop them and say, I want you to have a visual memory of this conversation and think about how you're going to make that happen for all the people in your team now and in the future.
I like to pay it forward, and I like that stop. Remember this moment and how you feel. That's a great mechanism to get people to remember. And I bet many of them do. Like a specific moment, they go, I remember that moment and how it made me feel. And that's what I'm aiming for. I like that. I'm gonna have to use that with my kids at some point. I have to figure out when the right moment is. It feels like a very kid-friendly piece of advice. Second question: What is the best piece of advice you've gotten about the consumer lending industry in general? You've been in a lot of different segments of it over your career. I'm curious, consumer lending, consumer finance. What's the best advice you've gotten?
The easiest thing to do is to give people money. The hardest thing to do is to get it back, right?
We talk about this all the time. People are like, it's hard to grow a lending business. It's easy to grow a lending business, man.
Right.
Open up a shingle, start handing out the money.
And having sat with in dealer tracks and buy here, pay here, right? These are subprime lenders. They always tell me, it doesn't matter how much money they give you, just get somebody to pay you something, right? Because once you do, that's the key to success. Always, just try to get them to give you something, even if it's $1. That's
the same thing I hear from my University Alumni Association about building a habit of giving. It's just first year you graduate, I don't need a lot, man. Just give me $5. But you start the habit of saying, hey, I'm a guy who pays. I'm a guy who contributes. I'm a guy who makes the contribution. And that sets your mindset and sets you down the path.
It keeps you in the payment priority, and that's an important thing. And I know sometimes, especially when we face things like the crisis we just went through, people are very concerned about, I'm going to lose that consumer. And the answer is, if they just keep paying you $1 a month, at least you stay connected to them, and you are now in their mental payment priority. And at some point, they'll have the capacity to increase that. But don't lose them totally, because once you do, it's hard to get them back.
Okay, you're the first person to give me that particular piece of advice. So I appreciate novelty and the advice. Keeps it interesting. And my last question for you, Vince, what's a bold prediction you have for the future?
It's probably not that bold, but I've always looked at, and I've lived through a couple of generations of what I call FinTech 1.0, FinTech 2.0, which is technology shows up, it's disruptive, people think it's a product, think it's a business, but it's really just a product, and then it gets adopted by the banks. I saw this with, the internet, people were, it's a product, it's a channel, internet banking, mobile banking. This time, things are a little bit different. And especially when you think about whether you call it banking as a service or you think about it as embedded finance, I think what we're going to see is a fragmentation of the banking industry over time. And I think that the barrier to entry has become so low, barring the regulatory hurdles that are out there, where I think consumers will feel much more comfortable banking in places that people probably wouldn't think they would. And think about it right now. Starbucks is sitting on top of $1.5 billion of balances on the prepaid cards.
Yeah.
So, I was around when people, in the late 90s, when people said Walmart's going to be a bank, right? So I think we're finally at the point where consumers will go to their service provider of choice and say, I go to Starbucks every morning and I pick up my coffee. Well, this makes some sense. So I've always been a big believer that banks have the trust, banks have the brand, and that's why they're successful at this. But sometimes I wonder now that it might become more fragmented.
And how do you square that with what we see, which is kind of consolidation? I mean, when I first got into the space, I was surprised. 5,000 banks, 5,000 credit unions. It seemed like a lot. And then I go back, what was it, 1970? It was like, it was a lot more. So we're seeing kind of a general trend towards consolidation in the banking industry. How do you kind of think about the that being different than your prediction about kind of a fragmentation of the space versus what we've seen as kind of a consolidation in general, at least at the level of traditional financial institutions?
Yeah, so I think you hit the answer at the end, right? It's a consolidation of the traditional institutions. The fragmentations will occur because people will have highly customized types of banks. A bank for I'm making it up. A bank for someone who is a labradoodle lover. I just feel like we're at that point where when we talk about show me, you know me, that you can actually do this, where people will just pick their favorite service provider and say, boy, they can provide these services for me. It makes some sense. So you asked for a wild prediction. That's my wild prediction.
Bold. I didn't say a wild, but I like bold. It's thought-provoking is always good. Gets us all thinking about what's next and thinking about kind of different perspectives. So I appreciate that. Vince, this was a great conversation. I really enjoyed it. Thank you for breaking the way as our first kind of fintech guest, and hopefully good reception won't be our last.
Well, listen, thanks for the opportunity to do this. I really appreciate it, Jeff. It was great.